The Shankar Sharma, and we'll just show you an excerpt of that conversation. Shankar Sharma joins us, needs no introduction, represents First Global. Shankar, welcome back, good to connect with you. We are talking to you at a time when I guess there is anxiety, there is nervousness, there is curiosity, and there is some degree of confusion. I mean, perfect time to get in a market veteran and get your thoughts. Before I talk about local view, your view on politics, or your view on what's happening on the geopolitical front, let's start with your worldview. What's happening to the world? 2019 was a shaky year. Everything took it on the chin. 2019, world's made a comeback.
World is fine. I don't think world has any problem. I mean, you can see how China has performed in the last few days' time. It's put behind the trade tensions, trade wars. The world is a very peaceful place. I mean, I don't see any problems. And I'm talking the world at large, not necessarily in our backyard, but the rest of the world seems to be talking progress and economy and rates and jobs, and I think the world is in a good place. I don't see any problem at all in the world. US is doing very well. Russia and Brazil have performed dramatically well. China, which was a laggard, has, in my view, now broken out, and I think now from you will see a lot of outperformance from China. So the world seems to be a great place to put money into equities. You can see even in the US, you had a very ugly December, but do you even remember that now? I mean, it has gained back pretty much everything. Even a stock, a laggard like Apple itself, is now at virtually a 3-month high. So things are looking good globally.
Okay, Shankar, if things are looking good globally, why is India underperforming? Is it news? Is it elections? Or this is purely catch up with the global averages, because 2018 was a nasty year for the world and we stood tall, and now we simply have to align with what the global market says. Like you always said that there is nothing exceptional about any market. All it matters is that where global trends are. Global trends in 2018 were negative, now they are better, but India has to align with global reality.
As long as we are going to do all that we are doing, I don't see why India should be bucking the trend that it has seen in the last few months' time. And it's just that stock markets, like peace, calm, harmony, progress, discussions around economic issues, discussions around employment, not discussions around the stuff that we are largely discussing these days, because that's usually a path to nowhere. Nobody got rich or prosperous discussing war and temples and cow and stuff like that. So simply I'm a little worried about the discourse that we have right now, taking us away from what really the country needs. And we need, obviously we need to grow a lot faster than we are. We need to have more people coming into the employment net. We need to have companies declaring much better numbers. So we need to focus on the good thing, but somehow the discussion and the discourse in India is a little different. And if you were to question that, then obviously you are yourself questioned as to why are you taking us away from what we love discussing these days, which is border and tension and Pakistan and stuff like that. So it's okay.
Shankar, we both know that good news and good prices don't come together. Right now, news exactly is not very market friendly, whether it is geopolitical, what is happening in border, or on the earnings front, or what we're getting from promoters, where some of the promoters have been caught with their pants down because they've got a lot of debt on their holding companies, or they perhaps have attempted to bite much more they can chew. But do you think now it's time to start shopping?
I mean, look, my view is that the stocks, some of them still are fine, some of them are dodgy. Many corporate groups look extremely dodgy. So there is a mixed bag of players out there. Several of them have corrected, which I think is great, and I think if you have a little bit of bravery in you, you can go and buy them. But to make a big market call and say that the worst is over, I think, at least I'm not prepared to do that right now. I could be very wrong on that, but that's okay. I'm invested, so I'll be happy if the market rallies and rallies sharply from here on. It's just that I don't want to stick my neck out and say that the worst is over and blood is on the street, so let's go and buy some stocks, because like I said, we don't know how the stuff that is currently dominating the chatter plays out. We don't know how all this affects the elections. So there are many imponderables out there. That said, I recognize the fact that sometimes market can do very differently from what people generally anticipate. I'm prepared to take that risk, and I would rather not stick my neck out and make a big call on where the markets are headed. But there are many stocks that look very, very attractive, and we'll stick to that.
So Shankar, let's look at scenarios. It's all about understanding the scenario which is in the price what markets are betting on. Scenario number one, the current government comes back into power in the current avatar. Scenario number two, the current government comes back with outside majority. And third is that we see a change of guard and a new government takes over backed by a different political party. What do you think is in the price? What do you think markets are betting on? Because the way markets would react would be a function of what is in the price and what scenario is already been baked in.
Okay, so let's look at the scenarios. Okay, so let's assume the same government comes back. All right. I don't see why that itself should mean a big up move in the market. Because if the same government comes back, you'll have the same policies, good or bad. I'm not making a judgment on that, but it'll be basically more of the same. In that case, the markets will just replicate or keep going down the path they have gone for the last few years, which has been not very bad, but not very good either. So it's been a mixed kind of a thing. We've generally been treading the markets. India has not been a huge outperformer or a huge underperformer, barring of course the last couple of months. But generally it has been an at the market performer for the last 3-4 years. So if the same government comes back, I don't see any cause to for the market to suddenly say, okay, so let's have a 20% up day, because it will be the same thing being repeated all over again. On the other hand, if another government comes to power, so the market is now left with a whole new set of things to figure out. So let us say the UPA comes back in some form, in which case the markets might say, okay, for a minute it's very bad news because we love the current government, and any stable government or any existing government going out is generally considered to be a bad thing. But then can sit back and say that, but we had the 10 best years of stock market growth under the UPA and the 10 best years of economic growth under the UPA. So maybe then these guys are not so bad. And remember, in the first phase, which was the best phase of the UPA, which was UPA 1, they had the left to contend with. Despite that, we had terrific numbers. So the markets, in my view, will sit and take a deep breath once the numbers are out. And in either event, I don't think you're looking at a very substantial up move. If the same government comes back, I think it will be more of the same, so it will just continue along the path. Other government sort of comes, it might have a down day, but I think the markets will then sit back and re-examine past data and say it's not that bad, and India's policies, for whatever they are worth, will still continue, and the government and a fresh government might give you some fresh thinking. So it's a complicated question, and there are no clear answers. But my sense is, same government coming back does not mean much for the market. Another government coming back for a temporary period might mean a bad thing, but market might then end up thinking that maybe new thinking might not be such a bad thing. So we'll wait and see.
So Shankar, you are of the view that markets are unlikely to move higher in the short term. The underperformance in India is here to stay. There is a case for anxiety because of geopolitical events and because of election. So what kind of picture do you think this market, what kind of picture do you think could emerge in the run up to the election? 10% fall, 15% fall, is that likely?
I always say that, there is, of course, if you're talking 10-15%, I don't think there's anything to discuss. If you're talking a 10-15% decline in markets and you're going to put 10-15-20% of your capital, I think that is a pretty good area. I don't think markets are going to decline 10-15%. That's going to be a huge fall if that were to happen. I don't think we are set up for that kind of fall, unless something very drastically wrong happens at the border, and you don't know how things can happen, some such volatile situations. So leaving that aside, I don't think markets are primed for a 10-15% decline. If they were to happen, there will be many stocks which will fall 30%, and they've already fallen 30-40%. That means you're looking at incrementally 50-60% from the peaks. As long as you're confident of the company's numbers and they don't have leverage, you can put money to work, in those kind of situations.
Shankar, you've been a big votary of small and mid cap stocks. Last couple of times we've interacted on this forum, you've said, look, I'm going to buy mid and small cap stocks. I understand how these companies work. But when there is such a negative wave of selling of mid and small cap stocks, when there is in general there is a lot of disenchantment towards mid cap and small cap stocks in general, how would you safeguard your small and mid cap portfolio?
No, not at all. Not at all. If anything, I'm even more bullish because there are even newer companies that I've seen look very good. Numbers are very strong. Yet stocks have fallen 30-40%. And I've always said that, look, this is a volatile category. If you don't have the stomach to, withstand on your portfolio 30-40% fall, then you should not be in this category at all. Or rather, you should not be in equities at all. Forget about small caps, because even large caps will take a 20% knock. So, I see any number of very, very good companies. Numbers for the next 12 months look in the bag, might be even 2 years in the bag. Stocks are down 40-50%. I think you're going to do very, very well, buying a number of them.
Okay. So let's talk about things which you've liked in the past. You've liked the chemical space in the past. There are a lot of chemical there were a lot of chemical stocks which were small cap. In the small cap space, they became part of the mid cap space, but after the market correction, they've gone back to the small cap space. Why do you like chemical companies? Why do you like some of these so-called old economy B2B businesses, which some would say do not have the pricing power?
No, there are many companies. I mean, entire chemical space is very good even now. You can look at companies like, for example, Vanity Organics. Just terrific, or Aarti. And these companies have been stellar performers over, literally decades. So, and there are many around that, smaller companies. There is a very tiny company which I can't name, which just in the last 12 months, went up, I think 20 times. There's so many names like that. So, if you pick them right, it's a sector which obviously has been very volatile over the last 10-15 years because of chemical prices moving all over the place. But I think there has been some kind of solidity coming in. But you have to work very hard, figure them out. I'm figuring out, one new company right now as we speak. Looks very interesting. So it's a good overall space, and that apart, there are all kinds of other small cap companies which don't fall into any category. I'm looking at a number of them. I'm very, very optimistic on this space without any doubt.
Do you think one should not get tempted by the price fall in NBFCs? You were the first one I remember who said, look, you don't like the way how private banks and NBFCs were conducting businesses. Private banks had their own set of leadership issues, but NBFCs now have a balance sheet issue. What is your read there?
Never ever say that in the financials, as to where this is the bottom, because you don't know. People start talking about, okay, so this was 4-time books, now book, this is now only 2-time book, or something that's 2-time book is now 0.5 book. You don't have a clue what the book is. Long and short of the whole story is that, because when you have on balance sheet, off balance sheet, all kinds of structured transaction, it's a whole black box in terms of balance sheets of financial, not just in India, across the world. India probably a little better. In that situation, the book is frankly just not simply calculable. When you can't calculate book, then why waste time calculating price to book? And NBFCs, I have been very clear, even in the boom period that they enjoyed for the last couple of years, that's not a sector, I want to put even 1 rupee of my capital into it. And nor would I advise other people to, but of course, it's up to people to take their chances. But it's basically a sector in which your cost of funds is higher than that of banks, and therefore you need to find higher cost borrowers and in order to make a reasonable spread. And as a result, you go out there lending to people who generally have dodgy credits. So it's a real estate or promoter funding and structured transactions, and all those things work well when you have a rising market. The moment you have a bear market, and we've seen a 12-month, 13-month bear market, that's when the tide recedes, and that's when collaterals are exposed. That's when, or the quality of collaterals is exposed. Then that's when you start demanding more cash or more collateral, and that's when promoters or your borrowers simply don't have additional cash or collateral to give you. And that's when your stock prices start to take hits, and which is why you've seen all of them collapse. And looking at valuations of NBFCs, how can financials trade at 7-time books and 6-time book and 8-time book? That's ridiculous. It's absolutely absurd. And even now after correction, they're like 3-4 times book value. I just don't think it adds up. This sector should trade at book, 1.2 book or 0.8 book. That's pretty much the range it should trade at, given the risks in their core business models. But in an euphoria, you will find these kind of companies running up a lot. I think they're just cooling off, but I'm not sure whether you've seen the bottom of this entire sector.
Sure, okay. What, to your mind, could be the second derivative impact of the slowdown in NBFCs? Because NBFCs ultimately were lending. they were lending to the consumer space. They were lending to the retail space. You know, the Bajaj Finances and some would argue the Cholas of the world, they've really created very big consumer retail businesses. Are we in for a sizable slowdown, if not in the infrastructure space, but in the consumer stroke consumption space?
Of course, the NBFCs were not really lending to the infra and all that sector unless it's at the promoter level. Otherwise, you know, that's a sector that they have not gone out much, but they have lent a lot to real estate, that we all know, and that's in deep strife. And a large part of the, or at least reasonably large part of the consumer boom in India that we have seen in the last 3-4 years has been funded by NBFCs. So if the credit sort of slows down, then it has slowed down. I mean, you talk to people are not extending credit anymore because whatever the inflows are is simply going to pay off the liability. So there is no net new credit being created by NBFCs in aggregate. That will have knock-off effects on consumption for sure. I mean, so I completely agree with you. You will see that happen. And consumption area of the market was the area which, for the stock market did what it did because of consumption story, not because of any other part of the story. If that slows down, I mean, we have a little bit of a pickle on the earnings momentum part.
Okay. Shankar, so what is your assessment? I mean, is it India more like a jackal in a hide kind of a situation where the good news is that we've corrected, valuations are looking reasonable, but the negative part currently is that we've got elections, we don't have a proper earnings recovery, so the consumption engine will keep the hope going and the investment engine will keep us dragging down?
You know, India has been a very confusing market. So in the last 6 months, there have been equal number of times when I thought that India is breaking out and is putting all the problems behind it. And just when I start to get a little confident, it just kind of reverses, including as recently this morning, you know, from where we started to, you know, then what it did during the day. It has been just impossible to make a very clear, to get a very clear line of sight into where India is going. I think on the balance, it does look that it will lag its peers in the emerging market space. That's at least my reading so far. The tape is telling you that. But like I said, it's been all over the place in the last few months' time. It's very, very hard to just put a clear view out saying that I think India is an outperformer or India is an underperformer.
Please remember. Okay. So Shankar, let's talk about asset allocation. You know, you've always said that nothing is permanent, equities always give a bunched up return. It is important to get the sector and the trend right, and there is always a bull market on somewhere in the world. So where do you think the bull market is on? What should be the right asset allocation?
No, I think emerging markets look very good. They've underperformed quite a bit, but I think they're coming back. US looks very, very good. So I think by and large equity looks good in this world. So equity is not in trouble at all. Equity is very, very robust. You would see the periodic correction of the kind we saw in December in the US, but I'm very optimistic on global equities. And within that, I think EMs look the best because they have lagged a lot, and with China now sort of coming back, that's a big market that has been a laggard. I mean, with that having sort of shown the kind of moves it has shown in the last few days, I think EMs look very, very good. So I'm very optimistic on global equities, very optimistic on emerging market equities.
Shankar, you're a great tape reader. You look at not valuations or pricing, but you look at the screen and the tape. So what is the screen telling you?
Well, that's what the tape is saying. I mean, don't take my word for it. You just have to go and see the tape, and the data is pretty clear that, and which is a bit of a concern and a bit of a disappointment, because usually India is a very robust market in good times and in bad times. And in good times, there is no crisis in this world of any kind. I mean, the world is going along pretty okay. In that situation, India should have been blowing out the lights. That we are not is a matter of disappointment for me as an Indian and for me as an investor, both.
Okay, Shankar, a bit of a nostalgia here. You know, you've spent about 30 years in the stock market. I'm not telling everyone to guess your age here, but we know that, you know, you've got like 3 decades of market experience. Which is that one big, I won't use the word mistake, but which is that one big regret you have about your investing career? Which is that one big asset allocation or stock purchase or stock transaction you would like to reverse? And hand on your heart, you would say, oh, I did a mistake, otherwise I would have been a billionaire.
It's very, very straightforward. I should have bought all the MNCs in India in the 90s who were trading at 60 times earnings onwards to 150 times earnings. So Gillette, Indian shaving products, or Gillette, whatever name it was then, was trading at 150 times earnings, and Lever, which was the cheapest, was trading at 60 times earnings, and everything else, Nestle and all the other trading between 60 and 150, and I thought they were very expensive and I never bought them. In hindsight, I should have, that was a big mistake. We should have loaded up on them, believing that India will always be expensive, and expensive towards so-called higher quality companies. I somehow could not ever believe that even for quality you should be paying 60 or 150 times earnings, but I was clearly wrong.